Now, this is the second last session of the conference, and in this one we're going to be looking at the economic environment and its implications for investment markets. So this session is going to explore what funds need to look for when assessing investment opportunities. And we're going to be hearing from Dr. Chris Caton, who is a former Chief Economist with BT Financial Group. So in terms of the format, Dr. Caton will give a presentation for about 40 minutes, and then there'll be Q&A at the end. As always, please use the app on your phones and just select Hall C, which is the hall we're in. But please put your hands together for Dr. Chris Caton.
Well, thank you, Del, and let me say it is a pleasure to be here. Just on my topic, it's going to be more about economics and less about financial markets than you may have been expecting. I apologise for that in advance, although to my way of thinking there always are implications for financial markets, and I will draw them out as I go along. I was introduced as the former Chief Economist of BT. I was. I actually retired a couple of years ago, so I speak to you now as a self-funded retiree, which gives me a somewhat different perspective. It also, while I was the Chief Economist at BT, I probably gave about 220 presentations a year. That's easy. And it's easy because you're never unprepared, because you've always just rehearsed, and because you always have an up-to-date presentation. Oddly enough, I say 220 a year, but it really picked up, and I find this interesting even in retrospect, it picked up to more than 300 a year during the GFC and the immediate aftermath. Oddly enough, at the very time that economists pretty much demonstrated they didn't really know what was going on, the demand to hear from them about what was going on went up. As I said, I retired from being BT's Chief Economist. I actually retired on my 25th anniversary as BT's Chief Economist. And one of the reasons why I retired was in that 25 years, and I'm the only person at BT who can say this, I was there for 25 years and I was never once promoted. So I figured, to hell with it, I'm out of here. And as I said, now my perspective is that of a self-funded retiree. So here are some of the things I'm going to talk about. We're going to have a look at the rest of the world, and essentially how the global economic environment is favouring or not favouring Australia. You would have heard some of that from Dr. Suter already. We're going to look at the Australian economy and the continuing effects of the mining hangover. And I guess my fundamental message here is that we're doing okay, but we're still. The economic growth is fine. It's probably better than anywhere else in the developed world. But as always in our industry, past performance doesn't always correlate with future performance. And every time we get good economic news, as we did 2 days ago, and thank God for that, because I obviously don't have the most recent GDP figures in my handout, but they do not contradict my view. Whenever we get good economic news, the analysis always seems to me to be they look at the figures and they say, okay, now this lot, and in this case it includes consumer spending, that's been doing quite well, so that's going to slow down in the future. And this other stuff, mining investment, that's been falling, so that's going to keep falling. There were always, whenever economic news is interpreted, basically, there always seems to me the first thing that happens is people get more negative about the immediate future. And I guess I'm not massively optimistic. The Australian economy has been growing at what I think of as a soggy but steady pace for several years, and I think that's the best bet. That will continue. It is true consumer spending will slow. But it's also true mining investment will stop falling, and that's all it has to do to start to add to growth. And it's also true, for example, that there's some export growth still to come. But I'll look more at that when I get to the Australian economy. We'll look at housing because we're all Australian and fascinated by what's happening in housing, and there is a lot going on there at the moment. We'll look at inflation and in particular the very, very low wage growth that continues in this economy. And that is a clear standout feature of recent years, and that is output growth has been okay, jobs growth has been okay, income growth has been lousy. And that it's in part because wages growth has been low, but there's another story there, and it comes back to the mining boom, the total economy, income growth for the whole economy, not just for the workers, income growth for the whole economy has been relatively slow in recent years. We will look at the state of the labour market thereafter, and then it says a look at markets, but that is a look at financial markets. So let's start with the rest of the world. This is how the world has been growing. Its GDP for the world as a whole. It's the line that's underneath. I guess that's a kind of a green line. You can see the GFC quite clearly. You can see since then growth has kind of meandered along, but right now it's as good as it's been at any time since the immediate recovery after the GFC. The line above that is the growth in our major trading partners. The gap means that we're selling to the right people. What's the single biggest reason for the gap between the two lines? Why are our trading partners growing faster than the world? One word answer, China. But then that's weird, isn't it? Because we know China has slowed. We know that prior to the GFC, it used to grow at like 10% a year, and now it's only growing about 6.5%. Now look at what's happened to the gap between the two lines. It's bigger now than it used to be, isn't it? How is that? How does that happen if Chinese growth has slowed? And it has slowed. See here. It has slowed from, let's say, more than 10 to 6.5. So why is the extra normal Chinese growth more important now than it used to be? And the answer is, of course, because it's a more important market for us. We all know, we've been told for years, how big a story China is. And I think because we've been told this so often, we've actually forgotten that it wasn't that big a story that long ago. That's illustrated here. This is the share of our exports going to China. And that's now around 30% of our exports. So this is why the supernormal growth is more important now than it used to be. And you may have forgotten this, but at the turn of the century, that figure wasn't 30. The turn of the century wasn't that long ago, was it? That figure wasn't 30, it was 5. And it wasn't until just after the GFC, in fact, that China became a bigger export market than Japan. Now, you might think there's some major risk here with having 30% of our exports go to one partner. We've been there before. Just after World War II, I would say maybe 40% of our exports went to the UK. But the UK turned towards Europe and forgot about us, and we survived. In the late 70s, 40% of our exports went to one country. What country was that? It was Japan. Japan entered a decade, 20 years, 30 years maybe, of slow growth. And yet we adjusted. And Dr. Suda made the point that China will probably slow at some time in the future. He's more worried about Chinese debt than I am. But it is true, China may slow, may have a very poor year. When it does, there is no question we will be affected. Australian exporters have shown one thing over a long run of history, and that is adaptability, finding new markets. So, China's a risk. Incidentally, and I hope this isn't politically incorrect, but I was fascinated by Dr. Suda's remarks that the Chinese basically are placing more and more attention on facial recognition technology. How does that work when they all look the same? Huh? If you think about it, that's actually a story about us, not about them. Here is turning to the Australian economy. Here's where we've been and here's where we're going. The blue line basically shows in the year to the March quarter, we grew by 3.1%. The figures we got this week showed 3.4% growth, which is in fact the highest growth over a 12-month period since the since the commodity price boom and its peak in 2012. Incidentally, that 3.4 is held down by the drought. The non-farm economy in the year to the June quarter grew by 3.7%. That's pretty impressive growth. But as we all know, the drought is having a major effect right now. Incidentally, I have a friend who is a farmer, and not that long ago, about a month ago, he actually won a lottery. He won $2 million. And I said to him, what are you going to do with the $2 million? And he said, I think I'll probably just keep farming until it's all gone. The Australian economy growing okay, and here are contributions to growth. The consumer spending, the biggest part of it, solid growth, but I'll come back to that in a minute. Housing, no longer really a contributor after a few years in which it was. Mining investment, still a drag. Non-mining investment, which was basically was not really helping all that much. It didn't pick up so much when mining investment fell, but has been doing a little better lately. And public demand quite strong. That's partly infrastructure spending, a lot of road and rail projects going on, and also the NDIS. But the public sector in the past year or so has contributed significantly to growth. This is where the low income story starts to build. This is a long, it's a long concept, if you like. This shows, look at the red line, it shows the increase in consumer spending after adjusting for inflation, so real consumer spending, the increase in consumer spending on a per capita basis on average over the past 10 years. And right now, it's essentially consumer spending on average per capita has grown by less than 1% per year. In the 10 years up to the GFC, and as you can see, that's lower than at any time in the past 35 years. And in the 10 years up to the GFC, that figure was 3%. So we've gone from an economy in which consumer living standards rose by 3% a year to one where they've been rising by 1% a year. And it turns out that in a sense we've been lucky to get that because income has been growing even more slowly than that. I did some figuring when we got the GDP accounts the other day, and corresponding with consumer income, there's household disposable income, which you can also express on a per capita basis. And if you do that, if you look at household disposable income, in the 14 years from 1998 to the peak of the commodity price boom in 2012, household disposable income per person grew by 39%. That's after inflation. So a bit short of 3% a year, but not that far short of it. Since 2012, household income, real household income per person has shown no growth whatsoever. Now, if you go from a world in which, income's growing 3% a year, thank you very much, on a per capita basis, remember, to a world where it hasn't grown for 6 years, it's going to feel like crap, isn't it? And essentially, it's slow income growth that is causing so much of the malaise, negativity about the Australian economy. But it turns out it's not just household income, which is partly the story about real wages, but it's really the income for the entire economy. And I want to show you that in just a minute, if I press this the right way. This would probably be one of the most important charts in this series, and so it behooves me to tell you that it's 2 years out of date. One of the things when you're a self-funded retiree is you wait for other people to update your charts, and the Reserve Bank has been very slack in updating this one, I have to tell you. But it gets to the question of what do you want an economic system to do over time? And one of the things you want it to do is you want it to deliver an increased standard of living for the people in the economy. Turns out there's only about 3 ways to do that. Number one, just getting smarter, working better, what you might call productivity growth. That's the number one wellspring behind economic growth over the years. We get better at what we do. Number two, I think of as the kindness of strangers effect. How good is it if you can persuade the rest of the world to pay a high price for what you sell to them and sell you their stuff cheaply. If over time they're going to pay you a higher and higher price to sell you their stuff cheaper and cheaper, that's going to be a real income gain for your economy, isn't it? Number three, and not thought of quite so much, you can raise the living standards of people if over time you simply send a bigger and bigger proportion of the population out to work every day. Now, with those three mechanisms in mind, let's start with the bottom line. That's productivity growth. You start in 1993 at 100, and basically output per hour is about 40% higher now than it was then. The gap between the first line and the second line is the kindness of strangers effect. Mainly reflects, it reflects the cheap stuff they sell us, particularly the consumer durables, but it also mainly reflects the commodity price boom. And if you look carefully, you can see the gap between the lowest line and the next one peaks in 2012, exactly when the commodity price boom peaked. And it has narrowed somewhat since then. So there's still a gap. So the kindness of strangers has still helped us over the past 25 years, 22 years on this chart. But it isn't helping us quite as much as it used to be. To get from the second to the third line, this is, it might surprise you the gap is this big. This is basically send more and more people out to work. And one of the reasons why the gap is as big as it is because when the chart starts in 1993, do you remember what the unemployment rate was? It was 11%. So just getting unemployment down, and you got it down to 4% prior to the GFC, is going to get you basically that gap. And it's not only unemployment coming down, it's also increased participation, particularly by women, that has led to that gap. Now take the peak in that line as it is in 2008, just prior to the GFC, the first peak, if you like. What that says is, if you look at the lines below it, in the 15 years from 1993 to 2008, for the economy as a whole, we're not just talking households now, but for the economy as a whole, real income on a per capita basis rose by 60% in 15 years. That's phenomenal, isn't it? Now have a look at what's happened since then. Absolutely nothing. Now, we're not the only country for which this is true, but we're probably, in the developed world, we're probably the one with the biggest contrast between the income growth that we used to be used to and the income growth that we've got now. And of course, this is why, even though the economy is growing okay, it doesn't feel great. Now let's have a look at some of the components of that growth and where it's gone. As I said, the mining boom is still writ large in these figures, and here it is in business investment as a share of GDP. At the height of the mining boom, that hit 18%, and in just about 4 years, it came down by 6% of GDP. So there's a 1.5% drag on growth every year for 4 years, just coming from the collapse of the mining boom, which is what this shows you. Some other things have been doing their best to go the other way. Public construction, as you can see, you can see the first peak there is basically the pink bats, etc. After the GFC, but you can see in just the past couple of years, public construction spending has gone up a bit, but it's gone up by a bit more than 0.5% of GDP, and we're trying to offset a 6% loss from the decline in business fixed investment. I just thought I'd throw this in here. It's a bit, but it illustrates the point, really. It illustrates how you look at the mining boom story. This shows you the share of economic output coming from each of the 6 states of Australia. And you can see the mining boom in Western Australia. The share of GDP coming from Western Australia went from 10 to, it looks like, about 16 or 17 in a very short period of time, and has since come off. Now, the other reason why I like this chart is it goes back 30 years, and it could go back further than that, of course, but no two lines have ever crossed. No matter where you look in the past 25 years, the ranking of the states in terms of their economic importance has been the same. But back to what's been growing and what hasn't been growing. Private dwelling investment has been trying to offset some of the decline in business fixed investment. We have had a housing boom, it is true, the figures we got there a couple of days ago actually showed further growth in the June quarter, but it looks like it's topping out, doesn't it? We know essentially, I guess the problem, of course, is that when you build, that cheap money has driven a lot of things in Australia, but one of the things it's driven is a housing boom. One of the things it's driven is housing prices. And after a while, these things tend to collapse of their own weight. And we are seeing some clear signs of weakness in the housing sector. Just breaking down the real dwelling investment that I just showed you into doing it by state and also by detached houses and higher density, you can see essentially where the boominess has been most concentrated, and that is really in higher density stuff in New South Wales, and to a lesser extent in Victoria. I'd also point you to the third line on the left, on the right-hand side here, which is what's been happening to higher density construction in Queensland. That looks to me to be a little ominous. It looks like they built too many. And now essentially they're backtracking on the addition of apartments, etc., in Queensland. And on the left, of course, you can see the effect on the Western Australia line. You can see the effect of the collapse of the mining boom. It has had a clear effect on housing in that state. Now, of course, at any one time, even if you basically stop approving new dwellings, there's always a pipeline of stuff that's still to be built. And there is quite a pipeline still going on there, again, dominated by New South Wales. That shouldn't be a surprise, and also dominated by the high density stuff. We really have become more Manhattanised in recent years. Having a pipeline of work still to be done is both good news and bad news. It's good news for GDP. It's not so good news for what's likely to happen to prices, because as we all know, we've already turned the corner in prices. They have been falling for some time, I think for 11 months in a row on average across the national capitals. The good news about that is, well, the bad news is that's relatively prolonged decline. The good news is it hasn't been catastrophically big so far. There are other signs, however, that the housing sector is topping out. This is approvals for the construction of new dwellings. You can see that topping out, and you can see where the boom was concentrated in the high density stuff and where it's going now, namely sideways. And this is approvals. These are lending approvals. These are people getting loans from banks, and it's actually not the number of people getting loans, it's the amount of money lent to them. And going along, I guess, with the fact that the collapse, not the collapse, but the petering out has been in the multi-units, it shouldn't be a surprise to see that most of the decline in lending so far has been among investors rather than amongst owner-occupiers. Now, of course, there's a lot of hand-wringing in Australia about house prices, how expensive they are. On the left-hand side here, it shows you just how much, essentially, let's say 1990, on average, houses cost a little more than twice as much as annual household income, and that figure is now in excess of 5. And there's an idea out there that we're the only country in the world for whom this is true. That is not true. We're competitive. There's no question about that. We're probably on the podium, but there are other countries for which this has happened. And of course, the reason for that is in the second side, the house prices have risen as rapidly as they have. That's not what's caused the rise in household debt relative to income. It is the other way around. People are, people are more confident about taking on more household debt now. Why do people take on more debt now? Because it's cheaper than it used to be. And for an individual householder, they'd say, well, I have to take on more debt. Look what's happened to prices. But when everybody can and does take on more debt, that's what pushes the prices up. But household debt, relative to income, yes, has risen. But as I said, that's happened in a lot of other places. And we always look at this bit, and we don't look at what we've got, what we've achieved partly as a result of going into that debt. That's what this chart shows you. The The debt to income ratio is drawn here again as liabilities to income. But there's a few other lines on here now. Financial assets held by the household sector relative to income. Dwellings owned by the household sector relative to income. And the net wealth line is the sum of the two immediately below it minus the debt. So, yes, it's true, debt has risen rapidly relative to income, but our net wealth, even after allowing for that debt, has risen rapidly too. So, as I said, we worry too much about household debt and prices to income. There's no question that some people will be stretched. There's no question, but it's not a macro issue in my view. And just a quick look, I don't know how readable this is, but this is what's happened in the year to July to house prices. And just basically to get a laugh, I've given you the median value of houses right down to the last dollar in the last column here. But you can see basically, well, the best place to have bought a house a year ago, and I would have told you this if you'd asked me a year ago, best place to have bought a house a year ago was Hobart. But across the capital cities in the past year, house prices have fallen by a little more than 2%. It has been a persistent but slow fall, it's not over yet, but I don't see why you would think there was a crash coming. It will be over eventually. Now, turning to overall inflation, there's no question it's low in Australia. Guy DeBell, an assistant governor at the Reserve Bank, gave a very good speech in the last month about where he basically tortured the inflation data until it screamed for mercy, but just showed you just how prevalent low inflation is across almost everything in Australia, except for the one item they can find on the Channel 7 News about once a week to illustrate that point that the cost of living in Australia is soaring. It isn't, of course. Now, the Reserve Bank has a target of between 2 and 3, and we're only just in the bottom of that range. So long as inflation is low, the next move in interest rates remains almost certainly upwards, but not for a long time yet. We're already in record territory for how long interest rates have been steady, and that record's still got a fair way to go. We're not the only country, of course, with low and steady interest rates. Almost everywhere, with the exception of the United States and Canada, I suppose, basically still has emergency low interest rates. Now, we all know one of the stories behind the low inflation. It's causing the low inflation, and it's caused by the low inflation, and that is wage growth. There's a wage increase in the private sector, less than 2% a year, and in the public sector a bit more than that. But we've never seen wage growth in the Australian economy like this, certainly not in relevant history. We're not alone in that. If you look across the advanced economies, look down at the bottom half of this chart, the blue line is the US, and the line in the middle is the euro area. First of all, wage growth low everywhere. And this I guess is just an effect of the year after year after year of lack of inflation pressures everywhere. Everything in wages and prices tends to grow slowly these days. Now, of course, if you looked in the bottom panel, you could say, well, yeah, it has been low, but it does seem as if the bottom has been reached and there is some move upwards. And I think that will be the case in Australia too, but wage growth will remain low for some time to come. This to me just kind of illustrates one of the things that's going on. The Reserve Bank basically liaises with firms and says, tell us about your wage growth outcomes. Where have they been? And if you took the 12 years to 2014, and you're looking at the purple columns here, essentially, in that 12 years, 70% of firms announced that basically their wage growth had been more than 3% a year. That figure since 2015 has been 20%. I'm adding up the last three columns on the right there. So you just don't get the kind of big wage increases that we used to get, and that's why overall wage growth is sluggish. And it doesn't matter where you look. This goes industry by industry. It isn't a surprise that you're not getting the wage gains in mining that you used to get. But this goes industry by industry, and you can't find an industry where wage growth hasn't slowed in the past year relative to where it's been in the past 10 years. The closest, I guess, is accommodation and food services, and I don't know what that means. Now, turning to the labour market, here's my two biggest complaints, if you like, about media coverage about economics. Number one is when it is reported that consumer spending has grown more rapidly than income, we are told that people have been running down their savings and they can't do that forever. No, they have not. Some have, but not on aggregate. Consumer spending grows more rapidly than income if consumers are running down their saving. Saving is a flow, savings is a stock. If you're running down your saving, that means you're adding to your savings at a slower rate than you used to be. You're not running your savings down. The other thing that I get concerned about is people basically say, oh, well, the unemployment rate understates the slack in the labour market, which it does. But they say, and this is because there are a number of unemployed people who would work more hours than they are working if they could. So I'm going to add them in. The unemployment rate, as usually measured, people that don't have a job but are available, have done something to look for a job in the past month and are available for work if one was offered, that unemployment rate is the light blue line. And you'd have to say in the past 3 years there has been a slow downward trend. The underemployment rate, which is really part-time workers who would like more work than they've got getting, is the blue line, is the top line. And people just add these together and say, so the true unemployment rate in Australia is 14%. And the underemployment rate's had an upward trend, isn't it? So basically when you add them together, you've still got a bit of an upward trend going on. Here's what's wrong with that. There's a lot of difference between some bloke that doesn't have a job and is trying desperately to look for one, and some bloke who, when asked, says, oh yeah, I wouldn't mind it if they gave me an extra shift a week. Why would you add that apple to those oranges? If instead you take the underemployment number that you hear and weight it by that, how many more hours would you like to work and how much effort have you made to work those extra hours? So basically weight those people down by those factors, and what you get, look in the left-hand side here, is the underutilisation rate, which is basically you start from the unemployment rate and then you add in the part-time workers, but you weight them by the number of extra hours they want. That shows you the underutilisation rate is not 14%, it's about 9%, and lo and behold, it's had something of a downward trend, as you can see. But there is no question the employment figures and the unemployment figures do somewhat overstate the strength of the labour market. And here's how I think about it. The employment since 2008 has grown by about 17%. And you wouldn't find very many developed countries, if any, that could match that growth. But to have a look at the green line, over that same period of time, the average hours worked has gone down by 3%. Now that might not seem like much, there's partly the shift from full-time to part-time, etc. That might not seem like much, but suppose average hours worked hadn't fallen at all over that period of time. The employment line would have come down to the second line there, and it wouldn't have grown by 17%, it would have grown by 14%. And think what would happen to the unemployment rate if that were true. There has been a cushion in the labour market in recent years, but it's been formed basically by a decline in average hours worked rather than anything else. Now, turning to finally financial markets, where are we standing and what is the outcome? Well, I've suggested that the Australian economy has been limping along, still recovering from the mining boom. There are elements of that recovery that are pretty much over. Mining investment's not going to fall anymore. LNG exports are going to pick up. The outlook for growth remains okay, but not great. The interest rates are going to remain about where they are, so that's not a bad environment for share markets. But because interest rates have been as low as they have been for as long as they have been, there's nothing cheap out there, nothing. Housing's cheaper than it was, but it's still not cheap. Long-term bonds. Who'd invest in long-term bonds at the current rate? And the share markets are looking pretty fully priced. I don't think this means there's a crash coming by any means, but there don't seem to be any bargains out there. I thought I'd just show you a long-term picture. I started at the end of 1994. Anybody remember 1994? It was a lousy year for pretty much every market you can look at, in part because the Fed raised interest rates throughout the year. But starting at the end of 1994, here's what the share price indexes for various advanced economies in the world have done. And you probably didn't have to be a genius to know that the US has beaten everybody else. And it's been a pretty poor 24 years to have invested in Japan. If that's news to anybody in this room, you haven't been doing your job properly. Now, where's Australia in all of this? Again, the same picture for the US and the MSCI for the world developed markets and Australia. And we pretty much kept track with the rest, with the world. And don't forget, the world does include the US, but we've pretty much been an average market by this measure. But it's not the best measure for investors, is it? Because investors don't only benefit because the share price goes up, do they? Particularly in Australia, you really have to look not at the price indexes, but at the accumulation indexes. And look at what happens when you do. It turns out that starting at the end of 94 and going all the way through to now, we pretty much tracked. We haven't followed the path exactly. We got ahead, and we haven't recovered as well since the GFC, but we pretty much track the US market. The accumulation indexes of both have increased by a factor of 9 over that 24-year period, and we've beaten the rest of the world. And of course, this is because why does the picture look so different? The comparative picture looks so different here simply because dividend yields in Australia are simply higher than elsewhere. The dividend yield in Australia remains around 4%, and if you look at the rest of the world, excluding Australia, it's closer to 2%. So don't ever, I'm sure you all know that you always, in the case of Australia, versus comparing it with the rest of the world, you really do have to look at accumulation indexes. I thought I'd show you emerging markets. Good luck with this. It seems to me that somebody's always trying to sell an emerging markets message, and you remember the US, the share price index was up by a factor of 6 over that period of time. So there's a couple, Latin America and emerging Europe, who over the same interval have done better than that, it is true, but trying to pick a winner here and try to figure out what's going to go up in the future. I guess everybody has to have some exposure to emerging markets, but there's no guarantees here, certainly, at least in my view. Now, did I miss a slide there? No, yes. Here are, in fact, I think I missed 2. Somebody must want me to finish quickly. Over the same interval, starting end of 94, which sector of the Australian market should you have been in? Again, this doesn't have the dividends in, so it's a bit complicated. Well, that's a limitation, but the answer is over that 24-year period, it almost doesn't matter. But it has mattered in recent years. If you start the same exercise at the end of 2013, you would have been better off outside of financials and outside of resources. But because that's been the case, if you just look at price-earnings ratios, and I'm well aware of the limitations of price-earnings ratios, but you'd have to say that financials and resources, just relative to their long-run average, look somewhere close to fair value, whereas outside of those two sectors, the PE ratio is basically the highest it's been, certainly in the past 15 or 16 years. So once again, past performance doesn't guarantee future performance. Now, I thought I'd just show you a quick look at bond yields. Something remarkable has happened. Something remarkable happened this week, actually. And this, I guess, is a function of the fact the US is raising rates and nobody else is. For some time now, the 10-year government bond yield in Australia has been below that of the US. As of earlier this week, our entire yield curve is below that in the US. And that's never happened before. Now I leave it to you to figure out the implications of that. And turning to, if you're in the investment world, you always have to think about the Australian dollar. It's never an easy thing to think about. In an average calendar year, the difference between the high and the low over the course of the year in the Australian dollar is about 14 cents. This year we started the year somewhere close. We were 80 so in January. We're what, 71 or 72 now. We haven't quite fulfilled that range yet. I suspect, if anything, more likely to lose a cent or two from where we are rather than gain a cent or two. But importantly, most Australian dollar stories are not Australian dollar stories at all. They're US dollar stories. We pretty much reflect whatever happens to the US dollar. So don't try, in my view, you don't try to analyse where the Australian dollar is going next by looking at Australian fundamentals, you look at US fundamentals. Incidentally, I speak with some authority here, this is going back a long way, but more than 15 years, but about 15 years ago, the Financial Review wrote to me and 15 other market economists, and they asked us to tell them where we thought the Australian dollar was going to be in 6 months' time. So I sent in my forecast, forgot about it. The Australian Financial Review did something which I reckon is unethical. They kept the forecasts, and then 6 months later they pulled them out again to see who'd done best. That's not fair, is it? But they, and this is an absolutely true story, they wrote this all up, and I was announced to be the second best forecaster of the Australian dollar, out of a field of about 15 or 16. Now, I think at the time it was, let's say, 75 cents, and I said it was going to 73, and it went up to 78. So I got the direction wrong, and I was the second best forecaster. So, you know, just bear that in mind when listening to people's views about the Australian dollar. But I actually think it's been quite stable for quite some time, as this chart shows you. It does fluctuate, of course, but it started with a 7, with some exceptions, for 3 or 4 years now. So in summary, the Australian economy is doing better than commonly perceived. There's always negativity about this, but we've grown okay. Over the past several years, and we've never before had a commodity price boom burst without there being a recession. And we achieved that on this occasion. Nevertheless, income growth, I showed you this in several dimensions, has been very low. There's partly a low wage story, but it's also partly income growth for the entire economy is going nowhere. In part because interest rates have been as low as they have been for as long as they've been. There are no bargains out there, but I don't see any risk of any crashes either. And interest rates, I guess current market pricing says maybe by the end of next year, the interest rate may begin to rise. The Reserve Bank obviously doesn't want to cut it further if it doesn't have to, and right now it figures it doesn't have to. I'll stop there, and I guess Del will come back up here and I'll take... Thank you.
Can you grab a seat? Thank you so much for that, Dr. Caton. Thank you everyone for your questions. Once again, I was monitoring them at the back, and feel free to keep the questions coming. Just make sure you select Hall C, which is the hall that we're in. Let's get straight into it because we've got just under 10 minutes on the clock and quite a few questions to get through. The first question I have, one of the audience members would love to get your views on the Royal Commission and the possible impact that it's going to have on banks and the role of superannuation going forward. There are a lot of people with a lot more expertise on this than mine. I must admit, having worked for a bank for several years, I'm very disappointed by a lot of the stuff that has come out. It is true, I guess, that there were a lot of, well, at best you could call them sharp practices. I think it was Warren Buffett's mate Charlie who basically said, you tell me what the incentives are and I'll tell you what the outcome will be. And I think that's pretty much what we've seen here. The incentive structure throughout the banking sector was, there were so many cases in which which persuaded people to behave in a manner that was unaligned with their consumers' welfare. And as I said, I feel a sense of disappointment in all of that. There will be less risk, I guess, taken by the banks in the future, and so basically cleaning up their act
isn't necessarily going to be a massive positive for the Australian economy. I don't think it's going to be a massive negative either. I think we'll finish up with a better structured banking system. There may be some short-term dislocation, but this is not going to dramatically alter the outlook for the Australian economy one way or the other. But as I said, I am disappointed.
This question here from Chris. Do you agree the decline in union membership and power has meant less pressure on wage growth, and as such, business is holding on to profits, which is in turn leading into the inequality gap?
Yeah, I do agree with that, and in fact, I should have mentioned that. If I were still doing 220 presentations a year, that one unquestionably have got mentioned. I just forgot about it on the way through. I think there is no question that that's one of the factors keeping wage growth down, not only in Australia but elsewhere, and that is a lot. There has been a shift in economic power away from that factor of production, labour/unions, towards business more generally. But as I try to show you also, it's not just that. It's the share of the pie going to labour has been held down by reduction in unionism, but the pie is no longer growing at the rate that it used to either. So, yeah, unquestionably a factor.
This question here from Sam Cecilia. What is the root cause of low price and wage inflation? What are some of the deflationary forces here at play? And what will make these deflationary forces go away?
Yeah, I guess the first thing is it feeds upon itself, and the global financial crisis was a massive disinflationary event. So it's difficult to remember, but in 2008, inflation in Australia hit 5%. So basically, the inflation has come down and the economies have just been wallowing along, improving, but not at a rapid rate. But there's been no spark to get inflation back up again. Now, the odd thing about all this, of course, is that if you took economists back 20 years and said inflation's going to go to 2% and stay there, and they'd say, that's great. You know, it'd be impossible to believe such a perfect outcome. Now that we're there, we kind of think that, it would be nice if there were a bit more. You can think, I guess, of inflation as the lubrication in the engine, and there's not enough of that at the moment. Now, there are other factors also. It is unquestionable, and I strongly recommend Guy Debelle's speech on this. It is unquestionable that the spread of the ability to purchase online and the ability to purchase from the rest of the world, it's unquestionable that that's been a factor also holding down inflation. We're stuck in a low inflation rut, and what gets us out of this, I don't know. But as I said, 20 years ago, we would have thought that'd be a great outcome. Now that we're there, we're not so sure.
What is the sustainable ratio for house prices to disposable income? How much would a small interest rate rise place unbearable stress on borrowers?
Now, I don't know what the sustainable level is. We're around about 5 now. And obviously the problem is, of course, the aggregate's 5, and you say that's not you can have a view that that's not a macro problem. There's no question that at the micro level, for some individuals, it is. Some people have stretched themselves too far, it is true. But that doesn't make it a macro issue. The mortgage rates, we've seen a fair bit of media coverage of the fact that the major banks have raised their rates by about 15 basis points on average, let's say. And I saw some analysis yesterday which said, let's take the typical Australian mortgage holder with a $1 million mortgage and calculated what that meant for that typical holder. The typical mortgage holder doesn't have $1 million mortgage, I tell you. And even if they did, that's $1,500 a year. For a 15 basis point change. Let's put it this way: if anybody is feeling the pinch because they just raised the variable rate by 15 basis points, they were in too far in the first place. I don't think the variable rates are going to climb significantly. I think on average, if you take into account all the discounts, etc., I think on average, the average housing rate is lower than it was 12 months ago still. But we make as I said, if a 15 basis point increase is causing you concern, you were in too deep in the first place.
But that leads really nicely into this next question, which is going to have to be the last one. Would you be able to comment on the inability of the RBA to use monetary policy levers, given the level of interest rates and the level of household debt?
Yeah, I think that probably was essentially. They cut interest rates and cut interest rates and cut interest rates. Although when we, at 1.5%, our cash rate remained high by international standards, and they didn't see all that much happening. In part because they were trying to offset this massive downdrag from business investment, mining investment, which I showed you. And then they got to 1.5, and they thought, well, we don't really want to cut further, and we do seem to have lit something of a fire under housing. That fire has now been lit for so long that it's gone out of its own accord. I think the Reserve Bank is kind of. I don't know if you would think of this as an inability to do anything else, but a feeling that, well, we don't really know what to do that's different from what we're doing.
And then you've got all these out-of-cycle rate rises anyway, so for the banks at least,
Yeah. Now, of course, if the banks raise their variable rates again and again, and the Reserve Bank was unhappy with that, it would offset that. It would cut the cash rate then. There's no question about that. But at the moment, I think they think we're low enough. We've been low enough for long enough. We really don't want to cut any further. There is no case to raise. Unemployment's coming down. Growth's okay. Let's keep it where it is and just see what happens.
Okay, and this is my very last question from David Hartley. Stephen Kinsella said that housing price corrections from unsustainable levels always result in a crash. Do you agree?
No. I suppose that depends on your definition of unsustainable. We've had a couple of periods just in the past 10 or 15 years, one around 2003-04 and one since the GFC, where house prices have fallen quite significantly. You can't really blame the first of those house price crashes for the GFC. It's an adjustment in the housing sector, and yes, it does cause people to feel less wealthy. So it does have some potential for impact on consumer spending, but most of the current economic problems, what's going on in housing might be at best a symptom of those problems. It's not a cause of them.
Okay.
In my view.
All right, ladies and gentlemen, please put your hands together for Dr. Chris Caton.
Thank you.